Hello, everybody, and welcome to a new edition of a Self-Directed IRA Saturday. Thank you for joining us. My name is Andrea, and I'm an IRA specialist here at Quest. We have a great presentation today. We have Josh Andrews from Paper Profits today with a great class. Excited for you guys to be here. We will go over some housekeeping before we get started. First, a little bit on Quest Trust Company, who's Quest. We're one of the largest self-directed IRA custodian companies in Texas. We have about 20,000 active investor clients across the country, about 2.7 billion in assets under administration. We're trying to get that to 3 billion this year. We have about 108 employees. About 30% of us are certified IRA service professionals. And currently we have about 400 million in undirected cash. So for those of you who are looking to raise capital, we're a great resource. Before we get started too, I'd like to go over this disclaimer. Remember, Quest Trust Company does not provide any tax, legal, or investment advice or endorse any products, services, or investments of any type. All information and material are for education purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investments. Really important. So, what's a self-directed IRA? For those of you who don't know, a self-directed IRA, really self-directed is a made-up term. Really, we use it for two reasons. One is to differentiate the type of investing that you'll be doing instead of your typical private invest or public investments in your typical stocks, bonds, stuff like that. You bring it over to Quest, and you are able to one invest it into private assets, which we'll go into further detail in a little bit, and two, you'll be able to really pick and choose what you actually want to invest in. Some of the benefits are, of course, diversification. You can have true diversification and have investments in both type of markets, the private and the public. Of course, tax savings, investing within an IRA. You don't have capital gains tax, for example, if you do real estate, social investing, and investing in what you know best. So if you already are an investor and outside personally, you can bring it in and do it with and grow your IRA that way as well. Here's some examples of investment choices. The most common and typical investment choices that we see that our clients do. So real estate, anything related to real estate, really single family foreclosures, commercial condominiums, buy and hold, syndications, etc. We also have private entity investing. So LLCs, LPs, JVs, oil and gas, cryptocurrency, promissory notes also around real estate, secured or unsecured loans, et cetera, et cetera. So those are just some examples that we do, or our clients do rather. Here's some classes that we always have. We have this class every Saturday. We have a live webinar also every Tuesday at noon. We also host a lot of lunch and learns. And so, yeah, we are big into education so that our clients have an opportunity to understand what they can do. And we also have socials and networking events that we call locally and in person. We have every first, second, and third Tuesday in Houston, Austin, and Dallas. And then we also have an online version of this for everybody nationwide to join. We always have this referral program. If you have an account and you refer anybody, you both get a credit of $25. So that's, and you can do this as many times as you want. So just something important to know. Lastly, I do want to go over this amazing boot camp that is coming up at the end of March. It is locally in Houston. So if you're in Houston, go ahead and join us on March 30th. Master Tax Avoidance Bootcamp. So get with us if you're interested. If you want a little discount as well, let us know. And then lastly, if you have any questions, we are a group of about 6 IRA specialists at Quest, and we'd love to have a chat with you, answer any questions you may have, and help you and support you in your self-directed IRA investing journey. So without further ado, let's go ahead and bring up Josh. I do want to say thank you, Josh, for being here and for joining us. If you have any questions, we'll have a Q&A session at the end where we'll be able to ask Josh any questions that you may have. Feel free to put your questions in in the chat, and then we'll get started. So just give us one moment. Let's bring Josh up.
Okay. Thank you, Andrea. Can you hear me all right?
Yes.
Perfect.
Go ahead, please.
Well, thank you so much, Quest team, for having us here today. I really appreciate the opportunity to share what I've been working on as far as investing for the last, let's call it 10 years. We work with a lot of Quest clients, so we're very familiar with Quest. Love that they're local. I'm here in Austin as well. So it's really nice to be able to do some education and help when needed. So a little bit about me. We're going to talk today. I'm going to go over exactly what we're going to talk about. I'm going to try to keep it to 30 minutes. So we have a little bit of Q&A at the end. And then I'm going to give a handout as well, some educational free stuff. So I live in Austin. I've been here with my wife for about 6 years. Love it here. This is a wonderful area. I began buying notes in basically when I had a day job, kind of on the side in 2012. And I started with my IRA. So it's actually interesting that we're talking about this, how to invest in alternative assets in your IRA, because that's really how I started. I got kind of lucky with a mentor. So it was a different path that was kind of a coincidence, but I actually spent $18,000 from my first note coming out of my IRA funds. So since then, I've done a lot more investing. That was a long time ago. I've authored an educational book called Paper Profits, and this was in 2017. I'm actually going to give you a link where if you don't have a copy, I encourage you just to go to the website and fill it out. We'll get you a free copy. It's a physical book. Actually, one of the founders or principals of Quest, Quincy Long, wrote one of the chapters in here. I think it's chapter 7, about how to invest in notes and mortgages, deeds of trust with your IRA. So it's all free. It's all educational. There's no selling. We're not trying to push you into anything. It's just how to learn about this asset class to see if it makes sense for you. So myself, I've purchased well over 1,000 loans, purchased and sold. And so I've seen all kinds of things, good and bad. And I'd like to share a little bit about that today, as well as talk about some market information that we're getting a lot of questions on and that you might have as well with regards to this type of asset, and what the risk reward ratio is and how that looks inside of a self-directed IRA or otherwise. So as I mentioned, our name is called Paper from my book, and Jane Wobbs. She's a wonderful partner. We've been together working on this. She joined, I want to say 3 years ago. She probably knows the exact date. But she has been the best find I could ever have. So she's a wonderful person. If you ever need to reach out to us, we do have some additional staff that we value very highly that helps us with our day-to-day operations, CPA, and then some other full-time staff as well. So what we're going to talk about today is, just like a lot of different types of asset classes, there's a lot of deep dive stuff you can get into. So I'm going to assume that we don't know much of anything about notes. So I'm going to talk just briefly about what they are, how they work and function, how you profit from them, also the risks, and then also how you buy those, how you would title those, what that would look like in your IRA, and how to chart out profit over time. And then, outside of that, there's another deep dive we could go into, but we don't have time. We're going to talk about some of the recent changes in the economy, right? So we're going to talk about the federal interest rate hikes, what that means for note investors, property values, where they're going up or down or staying stable, how that affects us, and then also inflation. We'll touch on that just a little bit, talking about what that means just in general for investing, and then also for folks like us who invest in notes and real estate. So as I mentioned, you can get a copy of my book, Paper Profits. You can go to this link here. I'll have this link at the end as well. So all you have to do is go there, fill out your information, and we'll ship you a free copy. So let's talk about, like I said, the basics of what a note and mortgage is. Now, a note really, they're two documents, and a note really is just a promise to pay. It's an IOU. So a note is typically not recorded at the county, but it is a legally binding document that states the term, how much was loaned, the payment, the interest rate, all of those things, when all of the money is due or the maturity date, those types of things. So that's the note. So it's the IOU, you can think of it that way. The mortgage or the deed of trust, which depends on the state, is the security instrument. So you can think of investors kind of like a bank where you have collateral. You're lending money or you purchased an already originated note that's already existing, and you bought that, and you want to make sure that your investment is secured. So if the borrower stops paying, either voluntarily or just because they lost their job or some other issue, that you have something to go back and recover your money, because notes typically are bought all cash. You're not leveraging, you're not getting a loan against a loan. And so you're typically spending a chunk of cash to purchase an income stream is what it is. And so a mortgage is secured by a property. In our instance, it's a residential property. So these are single family homes. These are not fix and flips or speculative ventures. These are something that are occupied with families, like you and I would have a mortgage on our house. So that's what we primarily focus on. So the mortgage or deed of trust is actually recorded at the county level, and that's the security instrument in the event that the borrower stopped paying. There are different types of notes and basic terms. So the basic terms are, you've heard of first lien, second lien, junior lien, subordinate lien. All of those just mean position on title. So in general, first in time, first in right, which means that the first one that was actually recorded on title is the one that's going to get paid first in the event of selling the property or in the event of like a liquidation, right? So if you foreclose and sell the property, that's typically what happens. So first position lien, of course, a great place to be because you're senior. You're going to get paid first in most cases, not always. The second position or junior, so you could have third, fourth, fifth, whatever, but usually those aren't purchased. It's usually a senior or a junior lien that's purchased. So junior lien is just recorded second on title, and it's literally the date and time that it was recorded. Performing means paying as agreed. So performing loan would be like a mortgage you and I might have on our house that we're paying to the mortgage company or the servicer every month. And as long as you're not behind or delinquent, you're performing. It's considered performing. So those are the safest, most vanilla loans you can buy. And those are typically the best bet because you're essentially buying those, putting those in your IRA and letting that interest compound, right? Non-performing means that they've stopped paying. So there's a difference between performing, non-performing. There's a band in there called delinquent. So you've got performing, delinquent, not performing. So we talked about performing. Delinquents where maybe they haven't made a couple months worth of payment, right? So you're not really non-performing until a loan has not made a payment for 120 days or greater. So before 120 days, the lender can't do anything. They can't start foreclosure or really send out any legal notices other than, hey, you're late. After 120 days, the lender can send out what's called a demand letter. And that essentially starts that first collection process, right? It doesn't force you into foreclosure, but it starts it. So you've got performing, delinquent, and then non-performing. Oftentimes delinquent, they start paying again. They get that letter and they're like, okay, and nothing's wrong. They go back to performing. Non-performing means that they've passed that 120-day mark. I mean, it could be years that they haven't paid. And now, they're just in arrears. They need to do something or the lender might foreclose and take the home. Reperforming essentially is the reverse of that. So reperforming means they had been non-performing at one time. Now they're performing and maybe the lender modified the loan. Maybe it was reinstated where all the interest and payments that were back due, the borrower came in and paid those in a lump sum and now they're current. So reperforming are actually really good loans to buy, provided that they are selected correctly and you do correct due diligence. Reperforming just means that they fell off the horse once, now they're performing and everything's paying as agreed. So there's lots of other different types of classes of debt, essentially. I mean, there's credit card debt, auto loans, there's commercial, there's fix and flip, there's bridge lending. I mean, the list goes on. So it's just like real estate or a lot of other classes where you can kind of pick a niche and go really deep. And so for us, we focus mostly on residential property. And we like that because there's a lot of emotional equity tied to that. People don't typically just throw their hat up and leave unless they're in really dire straits. It's not a business decision for them. And so it turns out to be a little bit more secure in a lot of ways. So we're going to touch a little bit briefly on why I believe that notes are a superior cash flow type of investment. There's a lot of investments out there, and if you're a savvy investor in alternative assets, you know that there's all kinds of things. I mean, there's real estate, there's tax liens, there's notes, there's gold and silver, there's cryptocurrency now, there's all kinds of things. So some of this has to do with your risk tolerance, what your ultimate goal is, not just to make money, but is this risk money that you can afford to lose or not? One of the things that I really like about mortgages is that you have a lot of safety and control. You're very much like the bank, where you've expended money as an investment with an expectation of a return, but it's not like a stock or something else where if the value fluctuates or gets cut in half, you're out on the street. You have something secured, an actual physical, tangible asset, the property, the home, that is being kept up by the borrowers, the people that are living there, to actually go, if you have to, and foreclose and recover your funds. Obviously, you don't want to go through that path. We'll talk about how often that happens, but you have something there, right? So you're not feeling like, hey, it could just be cut in half and I could lose everything. Notes are discounted. So discounting, essentially, this is what got me really excited in the beginning and still today. Discounted means that someone else has originated this loan, right? Like a bank or credit union or a private individual. And let's say the borrower owes $100,000. Well, we might actually buy that for $75,000, right? So you have $25,000 of delta there. Well, what happens with that? Well, let's say the borrower is paying 6 or 7% on the loan, and that's all they know. That's all they're going to pay. That's the terms. Well, because if you bought that at $100,000, which is what they owed, you'd be buying that at 6%, right? So that's what would be your return. But if you buy it at less than they owe, but they're still sending that full payment to you, what ends up happening is it's a yield calculation. So there's software that we use. It's pretty easy to learn. That tells you how much you're actually earning, right, on an annualized basis. And so you can buy that and you might be earning 10 or 12 or 14% because you got that discount. And what's better about the discount as well is when you do actually hold several of these loans, it doesn't happen very often, but occasionally you're going to have a borrower that pays off. So you'll buy a loan, $100,000 balance for 75, you'll throw it in your portfolio, it's paying, you forget about it, and then they sell or refinance their house. Well, they're going to pay you that 100,000. So you have $25,000 that just showed up in addition to any type of interest and payments that you've collected along the way. So it's a really, really neat idea. And you can do a lot of really creative work with buying things at a discount. And there's a whole nother, conversation or class that we could talk about. And it talks about it a lot of it in my book as well, if you'd like to look at that, kind of a deeper dive on discounts and how those function. So notes are a largely passive investment. They're not completely passive. You still have to, check your servicer. Your servicer is the one that's your face to the borrower that sends out statements. So there's still some minor communication or just checking your account kind of thing that goes on. But you really don't have a lot of those big responsibilities or liabilities that you do with real estate. Now, I'm not knocking real estate. I purchase real estate as rentals myself. I think they make a great marriage for notes because real estate has a lot of things that notes don't, and vice versa. Real estate has appreciation. It has a lot of tax advantages. The notes don't have tax advantages primarily. You're essentially putting forward money to buy an income stream, a set income stream, so you know that as long as the borrower continues to pay, here's what I'm going to make, right? So it's very scalable. The downside is it is getting paid down slowly over time. So it's not appreciating, and then the money that you are earning is primarily interest income, right? So you don't have huge tax deductions. But the value of it is it's extremely passive. You can just literally set it and forget it in most cases. And then also it's consistent. So there's nothing to repair. There's nothing, the AC unit doesn't go out. All of this stuff is the borrower's responsibility. And so all you're doing is just seeing checks show up every month in your IRA. And once you have enough, then you go out and you make another investment, right? So you compound. So that's what makes these really, really appealing. And you're involved in real estate without the hassles. So as real estate prices go up or the value, you're more secure as a lender. And when it goes down, you're less secure. And we'll talk about that in a few slides from now. But there's something there to take. It's almost like an option on a property, but you don't have any of the responsibilities of ownership, which is really nice. And then very, very steady cash flow. So these are ideal for savings accounts, IRA type planning, where you have a number of years to project outwards. You can say, hey, I just need to buy or invest this amount to kind of get where I'm going, along with all of my other investments, right? I'm not saying you should put everything into one basket. I don't believe in that. So what are the risks? Well, the borrower can stop paying. And if they do, like we talked about first, that's a delinquency, and then it becomes a default, right? Where they actually are non-performing, non-paying. So why does that happen? Typically people are living in their home. They have a family. They have kids in school. They have emotional equity in the property. They may have made upgrades. They know their neighbors. It's not like they just wake up one morning and they say, okay, well, this isn't working out. I'm not paying anymore. Usually it's death, divorce, job loss, or a critical illness where they just can't work, right? That's usually what happens. And so it certainly can happen. It will happen to a certain percentage of the portfolio. And totally, an actual total default is usually going to happen right around 3 to maybe 5% of the portfolio. So what that means is, let's say you had 100 loans, 3 to 5 of those are going to essentially go bad, where you're not able to, where they stop paying. You send them demand letters, you follow up, whatever, and you're not able to get them paying again for whatever reason. Then you'll have to go and decide if you want to sell those or foreclose or whatnot to get your money. So it does happen. It's rare, but that's also why you have the security and the collateral of the actual property, the mortgage or deed of trust on these, right? So any investment that nothing ever happens and is totally perfect is not really an investment. That's more or less like a loan or a promise. It's not something in real life that I've seen yet. And so it does happen, right? And there's a number of ways to exit that. And most of those ways are in your favor. So it's a good way to invest. So some of the keys, whether you're working with someone else, there's a lot of companies that actually manage large portfolios for clients and investors like ours. We do that. And you can also buy these for yourself, right? So if you want to go out and you want to find a loan, buy it at a discount, tuck it in your IRA, you can do that. So here's a few things to keep in mind when you're doing that. I'm gonna drink here real quick. Is, if you're going to buy more than one, first just try one. I recommend, if you don't have any experience, work with someone who's managing some, or just buy one, test it out, see if you like it. That's what I did. And I wanted to see the payments come in, right? And make sure this is a real thing. And then I kind of tippy-toed into more. But once you start getting up and running, essentially in every investment, we're trying to mitigate risk, right? So we're trying to get an upside. We know there's risk. We want to take as little risk as possible, but we want the maximum upside. So there is a happy medium for everybody there. Some people are extremely risk averse, and then other people are, close to gamblers. So it's going to be different for every investor. You and I might be different, what we think is risky. When you're buying loans, you want to have loans spread out in different geographic areas. An example would be Austin, Texas, where I live, is really big right now, right? So a lot of jobs, everyone's moving here, all that. I would not have, like if I was going to buy 50 loans or 10 loans, I wouldn't have them all here. And the reason is you don't know what's going to happen in the future. You don't know if there's going to be regulation that happens here. You don't know if there's going to be something happens that stifles job growth. And so it's good just to be diversified and have, pick different areas, metro areas that you feel good about. You don't have to do a whole lot of work, researching this. This isn't like you're buying a rental property, but more or less have it spread out. You want to stay away from rural properties, and that's the rule. There are exceptions to that, but you want to stay away from like farmland and very rural, out in the middle of nowhere properties, because if you do have to take that property back, they stop paying and you end up foreclosing, again, which is rare. You want to make sure that you can easily sell that property, right? So if it's in town or someplace local, that's pretty easy. If it's in the boondocks, it's going to be a lot harder. You want to make sure that there's enough equity to feel comfortable taking the property back. Now, equity is essentially the value of the property minus any loans that are on it. So first, second, third liens, whatever. So you want to make sure that there's enough value in the property at the time you buy the loan to where if things didn't work out the next day, there's enough there to sell the property. You also want to pay attention to state licensing and lender laws. So there are some states that are becoming a lot more aggressive. You don't typically need to be licensed, but you want to check with an attorney prior to purchasing. Some states you do need to have some sort of license where they want some money or you to fill out some things prior to actually owning loans. Not every state, but you want to double check that. You want to use a licensed servicer. So a licensed servicer is your face to the borrower. Don't try to contact the borrower yourself. Don't collect payments from them yourself. Just use a servicer. They're super cheap. They do a great job. And that's kind of your buffer, your firewall, your insurance against working directly with the borrower. These loans are very liquid. There's a whole secondary market of investors like us and private individuals that have money that will buy and sell these over a weekend. There's a lot of times where we're going to sell a loan and it's really just an email and we send them a few documents and they wire the funds the next day. So not every loan is like that, of course, but they are very liquid. The reason for that is it's all cash. You don't have this whole financing process like when you go to buy or sell a house. It's just cash. So the buyer has the cash or he doesn't, and he wants the loan or he doesn't. It can take a little bit longer to go through that process, but in general, they're very liquid. So it gives you an out if you do need cash back. And I know I'm running a little bit over time, so you can stop me if we need to. But I'm going to go into the next couple slides here about some of the questions that we're getting about today's economic times and how they actually affect note investors and note investments in general. So one of the things that we get a question about is, we've seen property values drop in some areas. We saw this huge run up in values in a lot of places, and now they've dropped. So what does that mean for notes and the security, and how does that work? Well, like we talked about, the property is actually the collateral. It's the security for you. It's your last resort. If the borrower can't pay, won't pay, doesn't care, you need your money back. So you're watching that collateral. So you have a point in time where you actually go into the investment, where you're doing your due diligence, where you're buying the note, and you're looking at the collateral, the value of the property, you're making sure there's equity there, all of that. Well, after you buy that, that obviously moves, right? Property values go up and down. If it goes up, you're more secured because you have more equity in the property. If it goes down, you have less. So down is bad, good is up. However, it doesn't mean that everything's over or you should just leave or stop or sell the loan if the equity goes down. And the reason for that is, unless it's deeply underwater or there's something wrong or it's just a bad area, low value home, typically people are not watching their home value. People that are living in their home, planning to stay, roots in the community, and they're not seeing it go down $40,000, and they're like, okay, we're going to pull the kids out of school, we're going to leave, let's go ahead and move. That doesn't typically happen. The only thing you're worried about is you're worried about the value of the home because of that 3 to 5% that you might actually have to foreclose on, right? So as long as the borrower is paying you, it really doesn't matter. What we do is we obviously provide, make sure that there's enough equity at time of purchase, right? So 80% CLTV, which is combined loan to value or better. And then after that, we proactively monitor the portfolio. We'll look at the home values every 6 months, let's call it, right? And so that way you're aware if stuff is going south, and you can say, hey, I can just tell this whole area is trending away. It's never going to recover. We could sell this loan to another investor. But in general, like today's declining values, it doesn't make any difference to our portfolio because the borrowers are still paying, and that's what we purchased, and that's what we're interested in. So again, just to recap, borrowers really just don't leave typically if the house goes down $40,000, $50,000 in value. They leave because they can't make the payment, because they have to move, because the house is underwater $200,000, you know, those types of things. That's why. And then another question that's on the top of a lot of folks' minds is interest rates. So the Fed, we've seen, you know, all these things up and down. It's going to raise them. It's not going to raise them. It is going to raise them. It's not going to raise them. How does that work with us, with these types of investments? Well, rates really only matter if you're going to go, if you need new funds to go get a loan. So we had rates that were, in the last couple of years, the lowest that I believe we're ever going to see in our lifetimes. 2.5%, 3%. That's not the norm. It never has been the norm historically. I mean, they've touched that, but very briefly. So rates going up is actually, in my opinion, a good thing. Rates only affect us as a lender if we need to go borrow funds. It does not affect our current borrowers. So a good example is, let's say I have a mortgage on my house, and I'm making my monthly payment, and it's a fixed rate, which most of these are. And the Fed could raise their new mortgage rates to 25%. It wouldn't affect my ability to make my current payments, right? It would affect all new people that are actually going out to buy a house to get a new mortgage. Of course, now their affordability on a house has just shrunk to nothing because their entire payment's going to interest. But for your portfolio and existing loans, any loans that you're buying or selling, those are all fixed rate typically. So the interest rate up and downs don't have anything to do with the actual performance or security of existing notes and mortgages. So in general, they're largely immune to interest rate fluctuations. The only exception to that, I would say that you will see, we actually did see when the rates were super low, 2.5%, 3%, we saw a lot of people refinance and pay us off. So we have loans that are anywhere from 5 to maybe 10% interest, right? So that's what the borrower is paying. So when they can get 3%, they're just going to be rid of us and sell. And that's a great thing for us because we're getting that discount like we talked about, right? That's coming in right away. So we're seeing less of that, but we're still seeing refinances. We're still seeing people selling their homes, moving maybe for a job. So you're still going to get that. But in general, rates are not going to affect your current holdings. And then inflation, this is a pretty complicated topic, but I did want to touch on it because it's affecting all of us. And it's not just a US thing. It seems to be global. And my opinion is inflation is an artificial thing, and it's caused by governments printing money. So it's fiat money, which is paper currency, printing it. We work for that for $1. And when it's printed, essentially you're watering down the supply. And so it costs more money for the same goods and services. So it's a little bit complicated, but that's the long and short of it. So to me, money is a kind of stored energy. And I say that because we spend our lives either working for money, either through a job, That's kind of how we all start out, or we become investors, or maybe something else, like a hybrid of that. So investing is a better way to go if you can, whether that's in your IRA or otherwise. But stored energy means that you're parking that energy in something. So for us, most of that, it's dollars. But as you can tell, and as we've seen, dollars are becoming worth less and less. So it's still a dollar. You're holding a dollar, you've got it in your wallet, it's still a dollar. But when you go to, let's say a coffee costs $1, next year a coffee might cost $1.25, right? So you still have the dollar, but it's the actual goods and services that cost more. So when you have money, the idea is obviously to store it and protect it in a vehicle that's going to protect your stored energy, right? So if you work for that, you don't want to have that kind of dribble away in inflation. So that's the basic idea. And money, again, is you can kind of think of it as like a claim, a potential claim on future someone else's time or energy. So with money, you can have someone help you do something, perform a good or service. Like that's really the function of it, right? So inflation hurts all of that. Inflation, if you're just saving money or not investing it, it's not growing. $100,000, saved in a bank is essentially going to be worth, whatever your inflation amount you believe is correct next year. I think the government just came out with the CPI. I want to say it was like 6.1 or 6.4. So what that means is, let's call it $6,400 every year is just gone of buying power. So I believe it's higher than that, but you can see that just saving erodes it very quickly. So you want to be investing it, whether that's in notes or anything else. It needs to be earning a return to keep pace. So dollars are not the best storehouse of wealth. I will still take dollars. They're not worthless because what I do with them is just like any other investor. I don't keep a huge cash balance and look at it. I invest it in some sort of cash flowing asset, like notes, like real estate, like other things where it's actually producing more and more. So the idea is to compound money, and notes are a great way to do that. The reason is you're getting very, very steady income. And it's almost boring. There's nothing to it. You're not flipping anything. And so as that happens, you put together a nest egg and you reinvest it. And the faster you can reinvest it, the faster your money is going to grow, and you're using compound interest. So that's the way to get ahead. That's the way to essentially get to a spot in life where inflation doesn't really affect you, because it doesn't matter to you if coffee costs $10, $15, $20 a cup. It just doesn't affect you anymore because you have all these things working in your favor. So it hurts savers and helps reward investors, people who are putting their money to work. So how do you put your money to work? Again, a lot of different ways. You can compound it, but notes make it really, really easy to compound. There's a number of different things I could talk to you about how to compound, whether in your own account or with companies like ours or others, but it's a very creative way to do it. So you want to stay ahead of inflation rates. And I think I'm coming to the end of my slide. I know I ran a little bit over. I just wanted to make sure I got enough info in there. Again, if you would like more information on these topics, a bit of a deeper dive into a lot of it, feel free to go ahead and get a copy of my book. It's free. We'll ship it out to you. You can also schedule a call with me or with my staff if you'd like. I'd be more than happy to talk with you about how to invest in your IRA. Like I said, we work with Quest quite a bit, and they're extremely responsive, really, really good company, of course. And one last thing I do want to mention is buying notes in your IRA. Essentially, it's just like titling any other asset. You would title it, for benefit of your company or your IRA name and number, and that would be the owner of either the shares of your company or buying the note itself. That would be the owner. You title it, and then the servicer would actually send payments to your IRA every month. So it would work very seamlessly. It's very simple, very straightforward to set up, and we can walk you through that if you ever need. All right, so that's all I have here today. Here's how to contact me, and feel free to reach out, and let's go ahead and open it up to some questions and answers.
Thank you very much, Josh. That's amazing. Great information there shared. Now let's open it up for questions. We received a couple as you were presenting, so let me bring some up here on the screen so that we can go over them. I don't know if you can read that, Josh.
Have you encountered first lien position, but you can't get paid? I have not personally. So we have both first and second position liens, and there's probably a number of title defects you could have where you would need to clear those up prior to getting paid. If you are a true first position lien and it's valid on title, there's not much that can stop you other than some statute of limitations issues, which mean, let's say the borrower hasn't paid in 10 years and you bought that as a non-performing note. There is a possibility that the statute has run in that state. It's state dependent where you're buying, that it's not collectible anymore just because they haven't paid in so long. But in general, you're going to get paid in some fashion. Now, I can't say you're going to make your money back because I don't know what you paid for it and I don't know what your other expenses are. But in general, you're going to get paid.
Awesome, awesome. Here's the next one. I think this is when you were talking about delinquent notes going into the next stage.
I like this question. Are you sure? So I'm going to tell you, I am not sure, but I'm 90%. So that's my confidence level. Texas is a little bit different. You're right. You may be able to send something out. The issue is the borrower federally has a certain period of time. So in other words, like if I have a mortgage in Texas, right? I cannot pay my mortgage for a couple months and they can't just sweep in and take my house. Like there has to be a statute of time. And my understanding, again, there could be some changes that may have happened, or I may not fully understand this state specifically. But my understanding is they need to be delinquent 120 days. You can still send them notices, right? So you can still send them late statements saying, hey, you need to pay, you need to pay. Your servicer is going to be doing that. I'm just talking about taking the first step where it's a demand letter, where a demand letter is typically the first step of the foreclosure process, where the lender's raising their hand saying, we're starting this, right? But I'll double check in Texas. That's a good question.
Yep, and I'm sure they can also reach out to a local attorney and get this
Yes.
question answered as well.
Absolutely.
1 second, let me bring up the next one. Here we go.
Property is free and clear, 1.2 million. How to construct the seller financing in order to sell a note? Please give examples. I would say you can call me and I can talk with you about this. Depends on what you're trying to do. When you're constructing a note, you want to think about your exit. And what I mean by that is think about if you have to sell this to someone, to another investor like me. Like, what am I looking for? So I'm looking typically for a higher rate because I can give you a better deal. So if the borrower is paying 9%, I can give you a much better deal with less of a discount to you. So you're making more money on the sale, as opposed to if the borrower is paying 4%. Because I have a certain metric that I need to hit as far as our return for our fund. And so I would have to ask for a bigger discount, and you probably wouldn't like that and you wouldn't sell it. So you want to think about that in mind. And there's some software called Time Value, or T-Value, that is amortization software that's pretty inexpensive. You can just type into Google T-Value. We use that and it's really, really good. And you can play around with the numbers and see what that looks like. But I would begin with the end in mind, thinking, I don't know what your basis is, what you've spent on this and what you need out of it, but thinking about how you can structure it at the best possible terms so a buyer can pay you max dollars for it. But you feel free to reach out to us. We could have a short call and I would need more information on the actual deal itself to be able to help.
Awesome. We have a good question here. What is the best way to connect with a self-directed IRA to buy notes? Um, I don't know if you want to answer this, and I can also. Um,
See, if you guys are with Quest, I'd say just give them a call. Quest is, and I'm not just saying this because of this webinar, but we've done a lot of stuff with Quest, and we get to see, because we have investors from all over different types of self-directed companies. Quest is by far one of the easier companies to work with. They just make things real easy. They're responsive. They're there. There are some nightmare companies. So I would say if you don't have an account set up, just call them, and they can walk you through that process. It's pretty simple. And then making the actual investment, let's say, whether you're investing with us or you're buying your own note, there's some documents that you'd have in that transaction, and you would fill out everything in the name of your IRA, right? So you'd have to have an account set up first with Quest, have that titling. You just ask them, how would I title ownership of an asset? And then all of the documents, purchase documents, you'd actually fill out with that, right? And you'd sign your name, and then you'd give that over to Quest, and they would sign it as well. So you'd sign and approve it, and then they would sign it as your, I don't want to use the wrong word, is it custodian?
right.
Yeah. So it's actually pretty simple doing that, but I would reach out to them once you have a transaction in place.
Right. I just actually answered in the chat to my direct email request where you can reach out, and I'll help you get all set up and answer any questions, any further questions that you have. So that's great. Thank you for that, Josh. Um, I think that covers it. There's a couple other comments, but no more questions so far. Um, so yeah, thank you very much, Josh, for being here and for sharing all this great information. You guys take a picture or take Josh's information down in case you want to reach out to him directly. But yeah, otherwise, everybody have a great weekend. Thank you, Josh, again.
Perfect. Thank you for
And
having us. I hope everybody has a great weekend as well.
awesome. All right.
Okay.
Goodbye.
All right. Take care.